Have you ever wondered what would happen to your business bank account if the bank where your money was held failed? So we had some bank failures a couple years ago, and back then we briefly touched on this subject, but today's video is about FDIC insurance and helping you understand what it is, what it covers, and how you can protect your business money. So if you don't know who I am, my name is Smolenski. I am a CPA and the founder of Clara CFO Group. And this channel and my business, Clara CFO, is all about helping small business owners make more confident and better financial decisions. So if that sounds good, you're very welcome here. Please make sure that you are subscribed to the channel because we have lots of information like this specifically made for you as a small business owner. This video is sponsored by Relay. Relay is a business banking solution built specifically for small business, and it has everything that you need to run your business completely virtually. You can set up new accounts online, you can have checks sent out, you can do direct ACH, you can do wire transfers, all of that directly from the Relay platform. One of my favorite things about Relay is that they also offer expanded FDIC insurance coverage, and that's what we're going to talk about today in this video is FDIC insurance coverage, and Relay offers up to $3 million of FDIC insurance coverage, okay? You'll realize why that's so great when we talk about what the limits are. But if you want to learn more about Relay, you can go to claracfo.com/relay, and Relay has very generously offered viewers of the Clara CFO Group channel an extra $100. So if you set up an account and deposit $100, Relay is going to match that first $100 deposit into your account. So they're going to give you a free $100 for setting up a new account after approval and everything. And we have videos on how to set up a new Relay account that you can check out in our previous videos. If you want to learn more, go to claracfo.com/relay. So what is FDIC insurance? First, what is FDIC? FDIC stands for Federal Deposit Insurance Corporation, and this is an independent agency that was set up by Congress in 1933 during the Great Depression to help consumers basically have more faith in the banking system. So they weren't hoarding their cash at home because basically they had been burned by banks in the past and they wanted to make sure that their money was safe, and the government had to figure out how can we make consumers feel confident about the fact that the money that they're going to put into the banking system is going to be safe. So they created FDIC insurance. And we do not pay for this insurance as consumers. The banks pay for FDIC insurance. So whenever you walk into a bank, or if you are doing online banking, they should have some sort of indication that they are an FDIC insured bank. Okay. And then you might be asking, well, I don't use a bank, I use a credit union as my banking solution. And if that's the case, they do not use FDIC insurance, but that doesn't mean that they don't have insurance coverage. They use something called NCUA, which is the National Credit Union Administration. So that is a separate thing, but it basically acts just like FDIC insurance. So a lot of what I'm talking today is going to be very similar if you have a credit union. I'm not going to go into the specifics if there is much of a difference because basically it's designed to do exactly what FDIC insurance does. So we're going to spend our focus on FDIC insurance today. So why do we have insurance? So basically this insurance company, the FDIC, is going to pay you back if for some reason a bank fails and loses your money. Okay, so if a bank overextends itself and they lose the $10,000 that you had deposited, then FDIC insurance will come in and make you whole again, okay, up to the coverage and limits amounts. So what are those coverage amounts? The coverage amounts are $250,000 per depositor, per insured bank, and per ownership category. So we're going to break down those different things, per depositor, per insured bank, and per ownership category, okay? So we also have funds that are covered by FDIC insurance and funds that aren't. So things that are covered by FDIC insurance would be checking accounts, savings accounts, money market deposit accounts, and certificates of deposit. Now, some things that aren't covered by FDIC insurance would be stocks, bonds, treasury bills, life insurance policies, crypto assets, and other sort of investable assets. So for your money to be covered, it really needs to be basically cash or light cash. So it's in a money market or it's in like a checking account. Like things that are invested are considered like a different type of, like they're not able to be insured, basically. The insurance company would not be able to insure all the ups and downs of the volatility of markets. So there's no way, and when you put your money into markets and investable assets, you are taking a risk with that. So cash is considered more safe because it also has this FDIC insurance on it. That kind of covers what is covered and what isn't covered at a bank. And then let's talk about like the depositor. So a depositor could be an individual like you or me. So I could go and I could have a personal account with a bank. And then I could also have a business account with a bank, which could be a separate depositor. So if the owner of that business account is a separate LLC or EIN, that would be considered like a separate depositor, okay? So I could potentially have at the same bank $250,000 of coverage for my personal account, but I could also potentially have $250,000 for my business checking account if that was owned by the EIN. For like the LLC actually owned that account. Now, you can also have a joint account where maybe it's two spouses, and that joint account, each individual could have up to $250,000 of coverage. So jointly, they would have $500,000 of coverage. Okay, so when you think about per depositor, you want to think about either basically kind of like based on Social Security or tax ID number. So if it's like a separate person who has a separate, Social Security number, or a separate entity, that would be per depositor. So if you were a person who had 10 different businesses and you had a different bank account for every single business, you could have up to $250,000 for each of those businesses, and that's in one bank. So that's one way to get some additional coverage in one bank, is to have these different depositors. And then another way to get additional coverage would be to potentially spread your money out between different banks. So me as an individual, I could have $250,000 at Chase, $250,000 at Bank of America, $250,000 at KeyBank, $250,000 through Relay. I could spread the dollars around that way. That's one way to do it. So some banking solutions, like I talked about at the beginning of this video with Relay, are able to offer higher FDIC insurance than that $250,000. And so now that you know that the limit is actually $250,000, you might be going, hey, but what did you said earlier that Relay has $3 million of FDIC insurance coverage. So what they are able to do, and what some other banks can also do, is that they use an underlying bank called Thread Bank that is FDIC insured. And so the money that you deposit into Relay is held at Thread Bank. And then Thread Bank has a program where they can move the money to lots of different accounts, so that technically no single account has more than $250,000 in it. So they use a network of partnering banks that they can spread the money out. So when you put money into Relay, the background infrastructure of the banking system is actually like spreading your money out into multiple different places. And it's still completely liquid. You could pull it out all the next day if you needed to. But what that does is it sort of diversifies the risk. And so it spreads money to different partnering banks so that you can get basically like you would be putting your money into lots of different accounts, but you don't administratively have to do that. Okay, so there are other banks that offer things that are similar. So you want to maybe ask, if you are with a separate bank, you could say like, hey, is there any way I can get a higher FDIC insurance limit? Because let's be honest, if you are a business that is operating at $1 million to $5 million in annual revenue, somewhere around there, and your operating expenses are $100,000 a month, $200,000 a month, $500,000 a month, you are going to need more coverage than $250,000 if you're going to be continuing to operate your business and you have some cash reserves to weather the ups and downs. So $250,000 honestly is very low when you talk about business accounts. A lot of us will have payrolls that are higher than $250,000 every time you run payroll. So you're going to need cash in the bank. So that's why we want to find solutions that are going to allow us to have this network of banks that we can put our money into one organization or to one bank, but then they will do kind of all the grunt work behind the scenes to do all of that electronic banking overnight and move the money into the right places so that it is all, safe and secure. Basically, that's what I would recommend for people if they want to get a little bit more coverage, is to look for something that does have that higher FDIC insurance limit. So you can talk to your bank about it and see. You can also open up a Relay account if your bank doesn't offer something like that, and it could potentially be a good solution for you. Let's also talk about ownership categories. So I'm going to go ahead and read this list of what these ownership categories are, because remember we said $250,000 per depositor, per insured bank, and per ownership category. So what is an ownership category? Ownership categories include single accounts, joint accounts, certain retirement accounts, for example, an IRA, trust accounts, employee benefit plan accounts, corporate partnership or unincorporated association accounts, and government accounts. Okay, so that's kind of, we were touching on that earlier, where you might have a joint account and a single account, or you might have a single account and a business account. That's what we mean by different types of ownership categories, okay? So all of those would potentially give you additional $250,000. So if you did have a trust account, you could have $250,000 of coverage with that, and then potentially a joint account, up to the $500,000 between the two individuals. So the FDIC does have a tool that you can go to their website. It's called EDIE, or EDIE. And you can go to that and you can actually put in your exact situation. So if you just are like, hey, I have no idea if I'm doing this right, first you can talk to your bank. That's one thing you can do, to say like, hey, how much FDIC insurance do I have with all of my banking relationship with you? And then if, for whatever reason they're not reachable or they're not helpful, you can go to EDIE, so it's EDIE on the FDIC insurance site, and you can actually type in, like, I have this joint account and it has this much money in it. I have, this business account, and here's the Social Security or the EIN associated with that. And then you can put it all there, and it will show you if you are over the FDIC insured limit in any of those categories. And so it can be helpful if you're just trying to make a plan, or you're trying to decide like, hey, I know I'm going to be growing. I know I'm going to need more cash. I know I might need to open up a new bank account. I need to know what my current bank will offer me based on everything that I've got going on. But this is where your banking professional can be a good partner for you. And if they are not, you might want to look into some other tools. Remember that Relay is a great banking solution as well. So you can check them out at claracfo.com/relay. So I think that we've covered everything about FDIC insurance. Please let me know if you have any questions in the comment section below, and I'd be happy to help answer those. We'll talk to you guys soon.